Good afternoon, everyone. Welcome to this TradeStation webinar. Thank you for joining today, and thank you for taking time out of your schedules to learn a little bit about futures. As you can see, we have a guest speaker. His name is Ryan Gorman, and we'll pass the microphone over to him in just a moment. I just have to take care of some disclosures and some introductions, and we'll get started in no time. Today's topic is managing futures trades. It's a focus on expiration, settlement, and roll process. And Ryan, who joins us from the CME Group, has a lot of experience educating traders on futures, specifically on those topics, expiration, settlement, and roll process. And he'll explain a lot of the things and a lot of characteristics that as traders we need to pay attention to. But before we pass the microphone over to him, just go through some of the disclosures. Just keep in mind that every symbol and idea that we talk about is for educational purposes only. These are not recommendations of TradeStation. Also, active trading is not suitable for everyone, and it should only be done with a risk capital. And past historical performance is no guarantee of future results. If anybody needs additional information on disclosures, please go to tradestation.com/important-information, and you'll find all the details on the disclosures there. Our friend Ryan, as I said earlier, visits us from the CME Group. He's been there for 5 years, and he educates clients on not only trading strategy, but also on market analysis and risk management. So Ryan, it's a pleasure to have you. Thank you for being here with us. I'm going to mute my microphone and pass the floor over to you, okay? Thank you for being here with us.
Awesome. Thank you so much, Jesus. All righty. Let me share my screen here. Get some of my slides going. Can you see my screen?
We sure can. Yes.
Awesome. All right. Before I get started here, what we're going to be talking about today. Again, I want to thank Jesus and all of TradeStation. It's an honor, truly. I really enjoy as an educator in the futures market, representing the CME to be able to talk about some of the intricacies of our markets. Today, we're going to be diving into managing futures trades, expiration, settlement, and roll process. Just a little additional background for me so you guys get the full picture. I started in the futures industry about 5 years ago. Where I started was with a smaller introducing brokerage firm here in Chicago. So I spent a lot of time on the phones talking with a lot of retail traders. And that ranged from gold and silver traders, S&P, NASDAQ, farmers and ranchers hedging a lot of their products, or just speculating in some markets, even some oil markets. So I spent a lot of my time simply educating traders on the phone about futures contracts, why they're important, how you can utilize leverage and utilize margin, some of the benefits of using our markets. And I parlayed that into working with the CME on the education team. So a lot of what I do is speak with specifically a lot of retail traders about some of the benefits of futures and different ways you can utilize it to try and enhance your overall portfolio and take advantage of some of our markets and the liquidity and a lot of the leverage you can get. But outside of that, what we're going to be getting into today is, again, managing futures trades, talking about expiration, settlement, and the roll process. So at a high level, there's going to be a lot of things we cover today. We're going to dig in at the beginning to a little bit about understanding futures contracts, a quick refresher, the structure, what a futures contract is, how it differs from just your typical stock. And then we're going to get into expiration, what happens when your contract ends and things to expect and avoid, the settlement, things like cash settlement versus physical delivery of contracts. We'll talk a little bit about the roll process and how to either maintain your exposure or at the very least understand what it means when your contract is coming towards expiration. Some key futures markets, unique characteristics, and then the best practices and minimizing pitfalls, ways that you can be most efficient using our markets. All righty. So talking broadly here, like what is a futures contract? So the textbook definition I have right up on the screen here, it's a legally binding agreement to buy or sell a standardized asset on a specific date or during a specific month. And transaction is facilitated through a futures exchange. So when I like to talk about futures contracts, what I've learned is a lot of people that are interested in finance, they understand stocks. They understand what a stock is. They understand equities. You have your Amazons, you have your Teslas, you have your Nvidias, all of these different things. And you can understand how those work. And futures contracts aren't too different. there are a lot of things that are different about futures contracts. The biggest one being that futures contracts are not assets. So if you own a bunch of shares of Tesla, more and more you own, that can be considered an asset. You are technically a part owner of that company. They convey no rights of ownership, nor do they pay or accrue interest or dividends. So those are some of the just key differences. But in terms of if you're looking to trade these products, the core, like essential things about trading remain. If you believe that, let's use gold, for example, if you believe that gold is going to increase in value, and I choose gold simply because over the last couple of years, just the incredible run that gold has been on to the upside, you can buy a contract with the expectation it's going to go higher. Conversely, if you think that gold's going to go down, you can sell that contract. So that mechanism of, hey, I think this is going to go up, I'm going to buy it, versus, hey, I think this is going to go down, I'm going to sell it, that remains the same. But a lot of the things you get into futures contracts are slightly different. So some of the key core concepts that you want to look at when thinking about it is there's an underlying asset. So crude oil, S&P, corn. So all of these contracts, they will track something. So for example, the E-mini S&P, the E-mini, micro E-mini S&P, just the corn contract, those all have an underlying that is important to understand. The contract size. So this has been a big development that we've seen, and we have a lot of data to back it up. But one of the ways that we think about our markets and think about different products that we could launch to our clients is we just listen to our brokers. We'll talk with TradeStation, some of the employees there, and say, hey, you're on the phones, boots on the ground with retail traders. What are they asking for? And one of the key things that we've seen over the past years is these smaller contracts. So having the ability to trade without needing $50,000, $100,000 in a brokerage account to get access to our markets. One super big thing I like to talk about, and it's something that I newly learned, was we launched our micro futures contract back in 2019. The NASDAQ today is trading above $23,000 per contract. Before we launched it in 2019, just 6 short years ago, it was trading at $7,600 a contract. That is a substantial gain that we've seen. And one of the reasons we see that is because we're seeing a lot of new participants in the market because of the availability to trade with a smaller size contract. Simply put, if you're looking at the S&P and NASDAQ right now, the E-mini contracts, the notional value is upwards of $300,000. And there's no shame in saying that's too much exposure for a lot of traders. People don't want to go to sleep at night knowing if they have 2 E-mini contracts on, that's over $600,000 worth of notional exposure. And so we have these micro contracts that are 1/10 the size that give a lot new traders the ability to come into our markets and trade. Along with that, we've launched like spot quoted futures recently, which again is a smaller sized contract, even than those micro contracts. Delivery month and expiration date is another thing that differs from just your plain stocks. All of the contracts, for example, the S&P might be the December 2025 E-mini S&P contract. So it will have a date where that contract will expire. And then if you're trading that contract, you will either have to exit your position or you will have to know that you have to roll that position and understand what the costs are associated with rolling that position if you want to maintain that exposure. The price quotations are also different. Every contract is different, a little bit different than equities. Most stocks, people understand if it's $100.20, it goes up by cents. So just every 1 cent the contract goes up and down is that value. And with futures, a lot of times you'll have a quarter point is the tick size. So there's some differences there. And then the margin. Margin is a big one that I see when I talk to retail traders is just a common thing that they don't necessarily grasp. In terms of equity trading, if you want to go in and sell a stock, typically in just your average equity account, what you're doing essentially is you're borrowing shares from the firm, and there can be borrow costs associated with that. So it's not as simple as just, hey, I want to sell this, I think it's going to go down. With the futures markets, they all have a standard margin requirement, an initial and a maintenance margin requirement. And as long as you have the initial margin requirement needed to sell or buy a contract, you can do so immediately on our exchange. So through our broker partners like TradeStation, you can go in with the futures enabled account and you can get it done as long as you maintain that margin requirement. So those 5 things are really like the broad basics, I would say, in terms of strictly futures trading that are your building blocks. If you're an equity trader, if you're an options trader, and you want to get into futures, these 5 things for whatever asset classes or products you're looking for are going to be critical and super important to understand. Getting into the weeds a little bit about what we're talking about today. So, expiration. So, basically, like I mentioned, futures contracts do have an expiration. An example I gave was the E-mini S&P December 2025. That might be represented as ESZ25. And every month has a code, a specific letter that will identify when that contract does expire. So, expiration is the date on which futures contract ceases to trade and obligations must be filled. So there's no more trading in that specific contract month, and your position is no longer active. And we'll get into it a little bit more, talking about which contracts are physically delivered versus cash settled, because that is a key difference. But getting into just a little bit more about expiration, there is essentially 3 key dates that you will need to know as a trader if you're holding a position. And now I do understand a lot of traders in the futures markets might not be holding contracts to expiration simply because the old, I don't want an oil tanker showing up on my front yard. I don't want 5,000 bushels of corn showing up on my lawn. And that's totally fine. But getting into the mechanics of it a little bit, basically the days that are very important if you are holding a contract is first notice day, last trading day, and expiration date. So, first notice day. So this is for physically delivered contracts. So this is the day where you must close or roll your position by this date to avoid any possibility of physical delivery. And again, talking about physical delivery, if you're working with a broker and you're trading a physically delivered contract, they are going to be ringing your phone all day long, emailing you, and potentially even taking you out of the trade if you hold that too far towards expiration to avoid that. Most retail traders, there's a lot of costs involved with taking delivery, and it's just not something that they would want to do. And it could just be a simple error or lack of education. The last trading day is the final opportunity to trade the contract on the exchange. So, any of these contracts that are being traded, there will be a final trading day. And all of this information as well, if you look at a product on CME's website and you go to contract specifications for a specific product, it will have this information along with an expiration calendar that I'll show you guys later. But all this information is fully detailed and at your disposal. And then we get to the expiration date of the futures contract. So it can be different from the last trading day. So it's something you have to keep an eye out for. But the contract officially expires and the settlement process is finalized. So essentially, expiration as a whole, understanding when these 3 days are, understanding your total risk that you have going into this, and understanding that you need to take action really before that first notice day to avoid any sort of issues is going to be really critical when you're looking at these different contracts. Then from there, we move into settlement. So settlement, fulfilling obligations. So basically, this is when we talk about cash settlement versus physical delivery. And I'll show you a nice chart that I actually recently made that I use this chart. When I am talking to people, it's very helpful to have this on hand because not all contracts are as intuitive as you might think on what is cash settled and what is delivered. We can all understand that your financial products might be cash settled, your corns, your soybeans, your wheats, your oil, those are going to be deliverable products. But the process of fulfilling the obligations of a futures contract at expiration is the general definition of settlement. So there's cash settlement. So financial settlement based on the difference between the contract price and the final settlement price. So again, hitting at that point where understanding when those final settlement days are, when the final first notice day is, and when settlement actually occurs is going to be important because if you are holding these contracts and that maybe they are cash settled, understanding when these are going to expire and understanding this is going to be cash settled or it's going to be physically delivered is going to be super important. And with cash settlement, there is, of course, no physical exchange of the underlying asset. And it's common for things like stock indices, interest rates, and like the S&P 500 futures contract, for example. The other side of the coin is physical delivery. Now, physical delivery is the actual exchange of an underlying commodity or asset. So if you hold the contract all the way through, and some you will have big firms that are taking physical delivery. You may have big corn or bean operations or grain elevators that or oil tankers, whatever it may be, that are the purpose is for them to take physical delivery. Maybe even if it is gold, if you want to have some gold stored in a vault, that is possible if you have the capital to make it happen. So again, it's a lot less common for your retail traders. Most retail traders, when it comes to settlement, will call their broker up or will just go ahead and roll the contract or just get out and then potentially look to jump back in the market when they feel it's the right time. And it requires very specific logistical arrangements. Like I mentioned, warehouse, shipping, storage costs, all of this different stuff. And as we talked about with your corn, your oil, cattle, these kind of products. So, really understanding what kind of product am I trading? Am I going to have to really even worry about this to a major extent? And again, this is a lot more of just education. If you work with a broker, they're going to help you with this. If you're in a physically deliverable contract, you are going to hear from your broker if we are nearing expiration or nearing settlement, because they don't want to deal with that either. So this is what I was talking about. So this is just a breakdown of some asset classes along with the futures contract and their symbol, and then the final settlement method. So what it does is looking at like the equity indices, looking at the interest rates, looking at foreign exchange, all those right off the bat intuitively makes sense that those are going to be come out and those are going to be cash settled. And then you get into some of the energies, some of the different oil contracts, some of the gold, silver, copper, some of those are going to be your physically delivered contracts. But then there's the standouts when you have QM, the WTI crude oil contract, and then the feeder cattle contract. Those contracts are cash settled. So it's not always 100% intuitive on exactly what's going on. So the roll process. So getting into this a little bit here. So closing out an expiring futures contract and simultaneously opening a new position in a deferred just meaning further out contract month for the same underlying asset. So essentially, if you're getting close to expiration or settlement in a futures contract and you want to go ahead and say, hey, I want to either maintain my exposure and I don't want to actually just cut this contract and then buy back in because I like where I'm at. That's where rolling comes in. The other options basically are, hey, you have to just eliminate your contract. If you're long, if you had bought two E-mini S&Ps or two crude oils, you could just go ahead and sell two. And then when the new contract is available, that next front month contract, you can go ahead and buy back in. But a lot of the times people want to maintain the exposure and all they want to do is have to cover the costs between those two contracts. So why roll? So as we talked about, maintaining exposure to the underlying market without having to actually take in that cash or physical delivered settlement. So we see this a lot. And back when I was a broker, I would talk to clients all the time holding positions. And a lot of the times that's what we would do. It was, hey, I still like the position. If you still like the position, I think we should roll this. Or it might be, hey, we've already made a good chunk of change, or maybe this trade is not doing so well. And I think we should just cut this and not look to roll it. And maybe we could re-enter. But the rolling gives you that opportunity to maintain exposure to that underlying market. Also, avoid expiration and associated complexities, as we talked about. It's just one of those part of the processes that you can take advantage of, where if you have expiration coming up, oh, I have to roll this contract. And that comes back to doing your homework and understanding when all of this is happening. When are these markets actually expiring? When is settlement? So how does it work? So I have worked on many different trading platforms, and it isn't the easiest thing just to do immediately. It was something I had to really learn and understand how to execute on a platform. So I always recommend doing as much education as you can with your broker and figuring out the best way to do it. But essentially what you're doing is you're simultaneously selling or buying the near month contract and then buying or selling the far month contract. So basically you're simultaneously selling and buying, and you're just basically shifting your position over to the new front month contract. And what that does, there is a cost with rolling that we'll talk about, but essentially it's a spread trade that maintains your overall exposure. And again, there is a bit of a window here called the roll window. What that is, it's just the period leading up to expiration where liquidity is good for both expiring and the next active contract. So the cost of rolling, as we talked about. So the cost of rolling basically is what we just talked about when you're selling or buying and then doing the same thing on the other side, when you're just trying to move that position to the next front month. And those, the two big phrases are contango and backwardation. But basically, the roll cost is the price difference between your expiring contract and the new contract that you're looking at. When we talk about contango, and these two are going to be super important to understand as you're looking at these contracts. Contango is when the deferred futures contract is trading at a higher price than the near month contract. So basically, the impact there is a cost to roll a long position and a profit to roll a short position. And it often reflects to interest, storage, these different carrying costs. And when it comes to backwardation is basically the opposite there. So it's when the deferred futures contract is trading at a lower price than the near month contract. And so again, the opposite there would be a profit to roll a long position and a cost to roll a short position, which often reflects supply shortages or high immediate demand. Now, there's a lot that goes into this, and I know this might be a little bit wordy, but I'm going to talk you through managing futures trades. So I think right away, when you think about managing trading, coming from the lens of thinking about equities or just thinking about futures, the first thing people might think of is, how do I manage my entry and exit? How do I use stops? Different things like that. But there is a lot more that goes into it. I think that's a base level. Using your stops, having effective risk management tools is going to be super, super important. But right off the bat with managing futures trades is know your expiration dates, mark them on your calendar. I can't tell you the amount of sticky notes. It might be old school, but I had sticky notes all over my monitors with positions, expiration dates of contracts that we were actively trading because you can't hammer that point home enough because the days sneak up on you. I'm sure we've all had deadlines sneak up on us at work. It's the same thing with trading. You might be in a position that you think has a lot of time to come back, and then all of a sudden it's coming up in December and that December contract is going to expire. Understanding settlement methods, as we talked about, so cash first physically delivered, the plan that you want to execute for rolling, whatever your rolling strategy is. Some people's rolling strategy is I don't roll, and that's totally fine. Whatever your strategy is, you should definitely stick to it or try to learn something new. But whatever your roll strategy is, that should be implemented probably before you enter a trade. Monitoring spreads, being aware of contango and backwardation. So being able to tell, hey, am I moving into a contract that is cheaper or more expensive than the contract I already had? And what is the cost associated with that? Utilizing roll orders if available. Again, like I mentioned, a lot of different brokers just have different roll methods. Some brokerage firms on different platforms will have a nice, easy roll button, and that's really great. If that's not available, understanding that a lot of these different things, excuse me, utilizing roll orders, sorry, just got a little bug in my throat. But understanding when these things need to be done, knowing how they need to be done is going to be super important. And if you don't know, maybe one broker you were with before had a roll button and the new one doesn't. So understanding exactly what you're doing and how to get in touch with people that can help you. Practicing risk management. Always define your entry, exit, and stop loss levels. This is the baseline I always start with when people that are new to futures trading. I think it's super important to not only help you sleep at night knowing, hey, I'm long micro E-mini S&P overnight, and I'm sure you've all seen overnight markets can move very quickly and very fast. Understanding before you enter a trade what your goals are for that trade. Okay, I'm going to enter this, I'm going to buy this micro E-mini NASDAQ. I think it's going to go up 10, 15 points, but I'm only willing to risk 8 points. So I'm going to put stops below it at 8 points and above it at 15. So if I am right and my plan was executed, I'm out of the trade and I don't have anything to worry about. It can help your whole process, and sticking to a process will help you grow and learn what works for you and what doesn't. The last two here, stay informed, keep up with market news and events impacting your contract. This all, again, comes with education. And I may be biased working on the education team here, but As education has grown, you're seeing people more and more in tune with the market. If they're ag traders, they're very into USDA and WASDE reports. S&P and NASDAQ traders might be very into economic events and what the Fed is saying. So understanding what's going to drive your market. And then just understanding your broker. So once you pick a broker like TradeStation that's going to work great for you and has a great front end system, understand what you're paying, understanding commissions, margins, any role specific fees. All this is just going to be ammo for you to strengthen your trading strategies. So getting into some of the things that can happen. So some of the common pitfalls that I've seen that we see here at CME and things that I saw back when I was a broker, forgetting expiration. The amount of times I was calling people over and over again to tell them that their contracts were going to expire and we needed to take action, and then them just answering and saying, "Oh, I was on vacation. I didn't bring my computer." And then we were able to manage the position from there. But understanding you have to know when these things are going to expire, ignoring roll costs, which can eat into your profits. So understanding as you're approaching when you might have to roll a contract that, hey, there are costs associated with this. So sometimes it might not make sense to roll a contract. Sometimes it might make sense just to cut the position and get out. Trading illiquid contracts. This again, making sure you're in a contract that will give you the ability to manage your trades. There are a lot of contracts out there. The CME markets like the E-mini S&P, the NASDAQ are extremely liquid, some of the most liquid markets in the world. But there are some different contracts that might be a little bit less liquid depending on the contract month you're using. So understanding that the volume is there, that the liquidity is there, and you're going to be able to utilize that to manage your position. Lack of understanding of contract specs. So this is a big one too. If you're trading a futures contract, I should be able to ask you, hey, how much is 1 point in corn? How much is 1 point in the S&P? Those kind of things are things you should know before entering a contract. What the margin is. How much margin do you need to have in your account at any given day in order to maintain that position without getting a call from your broker that you need to either cut the position or throw some more money their way? And then over leveraging and emotion driven decisions. A lot of the times this can happen at the same time. Over leveraging, futures themselves are inherently very leveraged products. And there's positives to that, being able to get a lot more notional exposure for significantly less margin relative to some equity products. And also understanding how to manage your risk that way. So a lot of the times when you really have high conviction on a trade, you might say, "Hey, I'm not sticking to my trade plan here. I really believe what if it's crude oil is going to go up $5. I really believe it." And you over leverage yourself, and that's where you get yourself into trouble. So always stick to your trading plan, stick to what has been working. If something hasn't been working, try and figure out a way to make it work, whether that's taking on less risk, maybe looking at different asset class, whatever it may be. But all this list here basically details is just common things that we see where people struggle with just managing futures positions. So this is a little bit blurry, and I will talk about it for a little bit here, but this is an expiration calendar, and this is available on CME. Basically, what you can do here is you can search by a product name. You can search a lot of different products on here, and it will tell you when these products are expiring. If it's an option contract, if it's a futures contract, it will give you all of that information. And then from there, you can go to the contract specifications page on that specific product as well, and you can see, okay, if I'm trading E-mini S&P, you might want to bookmark this page and have E-mini S&P saved on here because you're going to be checking that quite often, at least every couple of weeks or so, just to make sure that you're in the right spot. And then lastly, I'm just going to wrap up here before we dive into anything else. Again, the education in me is just screaming right now. But the My Portfolio and the CME Institute. So make your trading day a little bit easier with My Portfolio. It's a way that through CME's website that you can track all these different markets. If you're not really using a front-end trading system too often outside of order entry, this is a way that you can put in a bunch of different products and you can actually build out a portfolio. And in a similar way, on the CME Institute, if you're new to futures, or even if you've been trading futures for some time, this is a great place to go. I always say when I started at CME, I had been a broker for about 4 years at that point. I spent my first month at CME going through hundreds, if not thousands, of courses, lesson checks on the CME Institute refreshing and reteaching myself all the core concepts of futures so that I can deliver the material the best that I could to retail traders. And it benefited me in tremendous ways. So I often go back whenever I'm not quite sure. Maybe there's a specific part of a specific futures intricacy that I need to tune up on. I go to the CME Institute and I go through our education courses. They can be extremely beneficial. So I always recommend, even if you're trading futures, to go back and get a refresher. But if you're not, this is the place to start. Along with the CME Institute there on the education tab, you will see that there is a brand new state-of-the-art trading simulator where that's where you can start. You learn and then you try and then you trade. So you can learn all the concepts. You can practice executing trades with simulated money on the brand new CME trading simulator. And then from there, you can actually go open up a brokerage account and start live trading. It was a long time coming for this new trading simulator. If you use the old one, it was more of, hey, here's the price of the S&P futures. Here's the NASDAQ price. And here's a little chart. This new one feels a lot more like a true front end, sophisticated system that's very user friendly that we really spent a lot of time developing. So I always recommend starting there. A lot of the information I've taught you guys about is there. And then I'll leave you with this. Over the last 20 years, education has become so freely available. And we've just seen tremendous growth in not only futures, but our options markets as well. But a lot of that, if you go to our education page and see the hundreds, if not thousands of courses, educational material, if this was 20 or 30 years ago, that would have cost you around $20,000 or $30,000 to get access to all of this. And with the speed of the world and the need for education and financial independence, we've just seen a great shift, and all of this information is now available for free on our site with a login. So there's a lot of great information you can learn. You can go out and you can take control of your portfolio, take control and diversify your assets a little bit, looking at futures. And it can be very beneficial to start here. So again, I just want to thank you guys. I always love coming on here and getting in front of retail traders whenever I can to try and have my voice heard a little bit and let everybody know that although futures contracts may seem daunting, maybe you're an equity trader and that's all you've ever done and you want to stick to your guns. The gap between futures and equity trading isn't as big as a lot of people think, and it can be very beneficial. So again, I want to thank everybody for coming. Jesus, again, I want to thank you for hosting me, but that's all I got for now.
Thank you, Ryan. We appreciate your time. I appreciate your expertise on this subject as well. Somebody in the chat wanted to know if you were related to Wayne Gorman.
Wayne?
Yes.
I can't say that I am. Wayne doesn't sound familiar to me.
All right. But great information, Ryan, and thank you for pointing our audience to great educational content. I've also shared a link to our Futures Education Center where a lot of these topics are discussed as well. Let me see if there's any other questions here in the chat before we say goodbye to the audience. Swing traders holding positions over the weekend or overnight, removing the stop loss or putting it back when the session opens. Seems like it's more like a trading strategy type of thing.
Yeah, wait. So do any other retail swing traders hold positions over the weekend or even the overnight? If so, do you remove the stop loss and put it back on when session opens? Again, it is a good question. It's so much personal preference. Some people can't handle that risk of overnight because just for whatever reason, if you think about the notional value, a lot of people can get hung up on that and it can be daunting. So if you're comfortable and you think your position's in a good spot and you have tight risk management, holding positions overnight might be the best for you. I know a lot of traders that they'll cut their position by 2:30 no matter what. And that's just exactly what they're thinking of. And again, it matters a lot what you're trading. Some markets see a lot more volatility overnight. So I think that comes down to personal preference, and that really comes down to practice. If you find a strategy that works for you, that's going to be best.
And regarding the stop, as Ron is pointing out, the stop remains active as long as you send it as a GTC order. So there's no need for you to remove the stop and submit it again. As long as the order is submitted as a GTC, it should remain active and be there for multiple sessions.
Mm-hmm.
All right. Somebody's asking about the status of CME adopting perpetual contracts for stock market futures index positions.
Yeah, so that's like kind of the buzzword in the industry, right? Is the perpetuals.
Yes.
That's above my pay grade. That's not something that we really have gotten into yet. If it is a development, I'm sure we'll get into it at a later point. But for now, that's just a little bit above me.
Yeah. Now, for cash settled contracts, if no action is taken, does CME just take a reverse position and close you out? And at what time of the day? Is that handled on the broker side more than on the CME side, Ryan?
Yeah, that's correct. So
Yes.
you're gonna, and it depends on what the cash settled contract is for sure. But yeah, your broker, what'll happen is you're gonna get reached out to if you're holding, even if it's a cash settled position close to expiration, you are gonna hear from your broker. At least I would hope so. And
Yeah.
they're gonna be telling you like, hey, just so you know, here are your options, and they're gonna lay it out for you. It's a physically delivered contract they might be a little bit more aggressive and the process might be different,
Yeah.
but it is very different depending on your brokerage firm.
Yeah. And I may just talk here out of my elbows, but I would rather you ask our trade desk in terms of regarding the specifics of how cash settled contracts are handled at the time of expiration. So that would be my suggestion, just to call the trade desk and they'll give you all the details on what's the process there. I'm not aware of any BFF contracts being added to TradeStation. Do you know or have heard of BFF contracts, Ryan?
Yeah, so what that is, Bitcoin Friday futures contract. It's
Okay.
relatively new. It's basically a Bitcoin contract that's a little bit smaller size that expires every Friday. And that I don't know is the short
Okay.
answer. As
Yeah.
long as there is, all the different brokerage firms are different depending on what they offer. Just because CME offers it doesn't necessarily mean that whatever brokerage firm you're at is going to offer every single product.
Yes, and I don't have information on whether TradeStation plans on incorporating that futures or not. Again, the trade desk would be a little bit more informed about any new products that are being added to the TradeStation list.
Absolutely, they would.
Okay. All right. So I think we did it, Ryan. Hey,
Excellent.
Ryan, thank you again for your time. Thank you for being here with us. Hopefully, we can do this again on another topic. We appreciate your expertise, and we look forward to seeing you one more time here at TradeStation.
Oh, hopefully, yeah. Let's do as many more as we can, Jesus.
Yeah, this session was recorded. It's going to be available on the Futures Education Center at TradeStation. I've shared a link with everyone here. Let me just paste it again. If anybody has any issues finding content on TradeStation, please reach out to us, education@tradestation.com. I'm going to put that email address also here in the chat. Everyone, thank you for joining us today for this webinar, and hopefully we'll see you in another event. And make sure you check out the events calendar for upcoming topics. Goodbye, everyone. Goodbye, Ryan. Have a great afternoon, everyone.
See everybody. Thanks again, Jesus.
Bye-bye.